You're ready to pass the CPA exam faster? Visit cpapass.ai today calculating liquidity. Avoid the inventory trap on FAIR. Liquidity is the financial vital signs of a business, measuring its ability to pay short-term obligations due within 1 year. Creditors, auditors, and analysts scrutinize these metrics to determine if a company is healthy or drowning in debt. On the FAIR section of the CPA exam, examiners frequently test your ability to distinguish between different levels of liquidity stringency. You cannot simply look at a single raw number to diagnose financial health. You need context. Understanding how easily a company converts assets to cash to cover its immediate bills is crucial for passing these highly tested exam questions. Let's start with the most common measure of broad liquidity, the current ratio. The formula is straightforward: current assets divided by current liabilities. Current assets include cash, accounts receivable, and inventory, assets you expect to convert to cash or use up within 1 year. Current liabilities represent your short term bills, like accounts payable and short term debt, due within that same year. A current ratio above 1.0 indicates a company has more short term assets than short term obligations, which generally suggests a healthy cushion. However, this ratio can be deceptive. It treats all current assets equally, potentially hiding highly illiquid assets like slow moving inventory that cannot be quickly converted to cash to pay immediate bills. To address the limitations of the current ratio, we use a stricter metric, the quick ratio, also known as the acid test ratio. This ratio asks a tough question: can we pay our short term bills if we cannot sell any inventory? The formula is cash plus short term investments plus net accounts receivable, all divided by current liabilities. Notice what is missing. We completely exclude inventory and prepaid expenses. Why? Because inventory is the least liquid current asset and takes significant time to sell, while prepaids cannot be converted back to cash. By stripping these out, the quick ratio provides a conservative worst case scenario. Look at a company's immediate survival capacity without relying on new sales. This brings us to a classic examiner trap on the FAR exam, the inventory exclusion. Examiners love to provide a long list of balance sheet accounts, including inventory and prepaid expenses, and ask you to calculate the quick ratio. The trap is tempting you to include inventory in your numerator. Remember our key mnemonic? Quick means no inventory. In an emergency, there is simply no time to sell off goods to pay immediate bills. If you mistakenly include inventory in your quick ratio calculation, you will end up recalculating the current ratio instead. The examiners know this and will always place that incorrect number as a prominent distractor answer choice. Do not fall for it. Keep inventory out of your quick ratio numerator every single time. Finally, let's analyze how specific transactions impact these ratios. Suppose a company purchases inventory on account. This transaction increases current assets and current liabilities by equal amounts. If the current ratio was originally above 1.0, this equal increase actually decreases the current ratio. Now, what about the quick ratio? The same purchase has zero effect on the quick ratio's numerator because inventory is excluded, and however, it increases current liabilities in the denominator, causing the quick ratio to drop. Conversely, paying off accounts payable with cash decreases both the numerator and denominator equally, which improves both ratios if they are currently above 1.0. Master these transactional dynamics and practice them at cpapass.ai to ensure you are fully prepared for exam day.